Hello and welcome back to the ROI podcast, the podcast that's obsessed with the art and science of return on investment. And today I have a very special guest who chooses to remain anonymous. His real name is Tommy Deepwater. If you've been on Twitter, you know all about this guy. Amazing information around the offshore space, which, as you know, is an area of interest of mine. Disclaimer, guys, nothing we say here today is advice. It's just two guys having a chat over the internet, connecting via the amazing place that is Twitter. Tommy, welcome to the podcast. It is my absolute honor to be your first podcast, my friend. How are you doing?
It's my honor to be on your podcast. Thank you very much for having me on. I'm excited to talk.
Awesome. Let's jump straight into it. I would like, if you don't mind, maybe just give a 2-minute background into how you ended up into this space. A lot of people don't realize the level of knowledge which you have, but it's such an interesting story as to how you got interested in the offshore analysis.
Yeah, sure. So my background is I'm a debt investor, and I had previously been doing work on loans secured by offshore drilling rigs, as well, and mainly in the energy space, as well as like some land drilling rigs, pressure pumping equipment, a lot of stuff in terms of fracking in the United States. So my industry that I'd focused on largely is oil field services. So that's looking at offshore drilling, that's looking at onshore drilling. Also, too, I've looked at Canadian oil sands businesses as well. And at certain points, like I really, in terms of my career, I've really disliked offshore drilling. I know people know me for being bullish on offshore. There were times where I really hated it. And that was, back in 2016, 2017. It just looked really bad for a
The
lot of
peak
different
times.
reasons. And I far preferred onshore at the time, but now the cycle's really turned, and I think there's just a really good story to talk about this. Um, I think in terms of being a debt investor, um, unfortunately had to deal with some bankruptcies of these companies. So you really start to learn a lot about certain industries, particularly when you are long bonds and you have collateral and you're trying to value them, basically. So I've really spent a lot of time doing that. So that's really how I learned the energy industry, is largely being a debt investor going through a bankruptcy cycle back in 2015, 16, and 17.
Strangely enough, that makes a lot of sense. Do you think that gives you a big advantage as to an asset value approach? Because that's always the worry with these types of businesses, because they're so cyclical. The cash flows are much harder to predict, and their balance sheets, as you mentioned back in the day, have been pretty terrible. How do you think that differs from, say, an equity-based investor? I know that I like to look at these sorts of things as what's the replacement to asset value? Can they survive their debt maturities until they get to this inflection point that we're all expecting, where they start to become cash flow machines? How do you think your background as a debt-based investor has helped you in your analysis of these types of companies?
Yeah, no, it's a great question. Thank you for asking. So when if you go back to 2016, this was collateral. So basically, I'm a loan analyst, and I have these offshore drill ships. Largely, if you remember Seadrill or Ocean Rig, Pacific Drilling were large leverage loan issuers back then. And I have these loans that are trading in the market that I'm responsible for at 30, 40, 50, 60 cents on the dollar. And I have to report to my portfolio manager, who's asking me, hey, look, should we sell this loan? Should we buy it? And when you have these drill ships as collateral, you really have to go through and do a discounted cash flow analysis in terms of the day rates, what it costs to operate. Back in 2016, 2017, just the market just looked so terrible for offshore drilling that, honestly, probably like one of the you know, best base case that you could actually see one of these things start generating cash flow would probably be like in 2021, just because the cycle's just very long in offshore drilling. So I spent a lot of time looking at the specific, if you really dig into this, and this is what I do most of my time researching, is looking at spec sheets for these offshore drilling rigs. And there's a lot of differences on them that can make a difference in terms of the day rates. So when you're modeling day rates for future free cash flow production, there are some of them that might have 2 blowout preventers, or certain mud pumps that are really good, or dual derricks. a lot of specific type of stuff, but it can make a big difference on the day rates. So that's what I spend most of my time doing, is because these are really free cash flow generative assets, when they're contracted, and trying to understand the marketability of these assets as it relates to their unique specifications. Because basically, if you're a portfolio manager, you really have to, not that I was doing a PM at the time, but like, you have to put a fair value on a loan that's trading at distress levels. So I really had to put my pencil down and try to, get to work and put valuations on some of these back then, which was really difficult because, you were looking like 5 years out until like the next, contract you might get on one of these stacked drill ships in like Greece or, in Western Africa, where they're stacked for years to come. Now it's so much easier. It still is kind of difficult, but there's a lot better visibility in terms of when these rigs are going to be contracted. So it's a lot easier trying to value these today than back in 2016. And in terms of the longevity of the cycle, I can have a higher, well, at least as I view it. We can talk about that later, but there's just a higher degree of confidence when you're modeling those cash flows out.
Okay.
And some of these companies are really good too. And I'm not going to run on too much more, but Transocean, some of these companies, if you go to their fleet status reports, you can get really good information in terms of their day rates. You kind of have to guess in terms of the operating costs, but you can model these out. It's not too difficult if you look for the data.
Okay, that's super interesting. So, following on from, I guess, the very painful bear market, and then we had a lot of bankruptcies. How is the overall sector looking now compared to where it was in terms of balance sheets? You mentioned there's a path to free cash flow generation now that people can see, whereas before it seemed to be a long way off into the future. What would you say are the most important differences between where we are in 2023 versus, let's say, just after 2015, 16?
Yeah, great question again. So I would say there's probably 3 big differences today versus where we were in 2015 and 16. One of them was is offshore drilling back then used to have break evens and like this, or at least for like Total or Exxon or Chevron to do an offshore project, you might have needed to have oil prices of $75 a barrel sustained for a while before you would make a very long-term investment like that. That was competing against other lower cost sources of oil, mainly shale. Shale grew a lot. The Permian Basin in West Texas and in eastern New Mexico, that was a lot lower cost back then. I think that, once WTI would hit $55 a barrel, these companies would start investing. And, deep water projects were $15, $20 a barrel or higher. So the one thing that's really changed over time is that shale, Permian added 4 million barrels a day, which is just an incredible number to add in like 5 years. But deep water projects have their costs have really reduced, and also the time to first oil. So in terms of, you look at today, like the break evens of some of these projects, in a lot of cases, these large oil companies are saying we're going to continue investing in offshore projects as long as oil prices are not sustainably below $60 a barrel. So the costs have come down in deep water significantly. Shale, I will say one thing, that when you look at oil prices today, they've kind of gone down because shale production is actually surprised to the upside, which has kind of been a surprise to me as well as some other people. But that's been one thing. I really think shale in the United States is not going to grow a whole lot more. I think it's really capped out in terms of its capacity.
And that
But the big thing in terms of
does seem to be rather gassy based rather than like oil liquid.
That's exactly right. Exactly. Yeah. So it's really gravitating more towards, natural gas liquids and gas. And you look at natural gas prices in the United States, they're just super low just because there's just so much of it. And, that's not going to stop, for a generation. And the big thing, Benjamin, that's the big difference this time versus back then, is there's no new order book in terms of these drill ships. I remember looking, I told you about how bad the market looked in 2016 because shale was cheaper. Deepwater took a lot longer to bring online. It was higher cost. And you also had to deal with, it's 4 or 5 years until you actually start producing in deep water. So the demand picture was really terrible. And also too, there was tons of new builds that were made from the time period of 2012, 13, 14. They kind of stopped in 2016 in terms of new orders, but the shipyards, in Singapore, South Korea, I mean, they had like 40, 50 new build drill ships the market was going to have to absorb. And that just, it was just a terrible demand picture. It was a terrible supply picture as well. And it was going to take a very long time for the market to clear all of those new build drill ships that were being put out there into the market. And there's no new orders at all today. What's crazy to me is I kind of walked away from this industry with doing something different in my career. Hoping that after 5 years the market would come, or at least the market would clear these drill ships. There's still a few of them that remain. There's a term like stranded new builds. Some of those were ordered 10 years ago, but there's not that many left anymore. There's maybe 5 drill ships depending upon the status. So there's a lot less new incremental supply that's coming into the market, and there's no new orders being made. So that just really helps the pricing power for these offshore drilling companies. And I think that's a big fundamental difference today versus back in 2016, when all of those companies, pretty much all of them except Transocean and Offshore in Norway, avoided bankruptcy, but everybody else filed for bankruptcy and wiped out their debt just because the picture was just so terrible.
Definitely want to, you're leading into it. Very good first podcast guest, I have to say. So let me put this to you, and then you tell me where I'm going wrong. So my thesis here, we're following the CapEx cycle. We're going to have demand for oil continue to grow. People believe that the shale numbers are still going to continue, which I disagree with for reasons that we've already mentioned. The CapEx is going to have to go somewhere to get the oil. The oil is going to be found more towards offshore projects now for the reasons that you mentioned, lower cost of lifting and all the rest of it. And yet at the same time, the businesses in that field, the number of beneficiaries, let's call it, have reduced a lot through consolidation and balance sheet cleaning, etc. And the last remaining Achilles heel to that theory is that if these companies were to go mad and dilute the order book, that's not going to happen for how long? Like, how long would it take for the fleet numbers to significantly change across the board globally, given what we're seeing now?
Yeah, I mean, it would take a really long time, and it would cost a lot of money too. And the one thing too, and I kind of dealing with the bankruptcies, is a lot of these companies, I don't want to name any names, but a couple of them had really bad reputations of trying to find ways to get out of new build orders, and in the shipyards, I think a couple of them filed for bankruptcy because these cost $800 million to build. And if you only put a 10% down deposit, which is kind of the terms back then the shipyard's taking
walk away.
Yeah, absolutely. Well, the shipyard's taken a bunch of credit exposure to these offshore drillers. And honestly, they got burned pretty badly by this industry. And I don't think they want to go back and do a whole lot more of this business. Now, over time, they might take a couple drill ships here or there. But the big difference in terms of the terms is you might have to put 40 to 50% down on a new build order that could be anywhere, depending upon the specs, anywhere between $800 million and maybe even more than $1 billion. So that's cutting a check from day one at $400 million. It just doesn't make any sense for these companies to do, because you're putting $400 million out the door potentially without delivering an asset for 4 to 5 years, because it takes that long to build those, when your stock is valuing your company at a price lower than $400 million per rig. So it just makes so much more sense just to repurchase shares than to make a new build order.
And so where's that inflection point? So at what sort of day rates and what sort of contracts would need to be secured such that these shipbuilders would feel comfortable, or that the companies themselves would feel comfortable in investing that capital into more fleet or more vessels? And how long do you think this cycle might take compared to previous cycles?
Yeah, no, great question again. So when you're talking about, you're going to look at day rates because, going back to what I was saying before, it's like you want to model out the cash flows. You want to make sure if you're going to invest $800 million into an asset, you want to make sure you want to get an IRR, a return on your cash flows in the future of at least 15%, if not higher, to justify the investment. And to get to that level, you need to start to see day rates. It depends on who you ask. It needs to be at least 675 to $725,000 a day, and you need to get that over a very long-term contract to justify the investment. So you need to have somebody like Shell or Total say, okay, if you build this drill ship, we'll take it for 10 years and we'll give you a day rate. We'll pay a day rate of $675,000 a day. That's a really good day rate. That's kind of like where day rates had peaked in the past cycle back in 2013. We're still a long ways away from that today, and that's why I really like the cycle, or at least the offshore sectors, because we're kind of looking at day rates today on higher spec drill ships and semi-submersibles, in the mid to upper $400,000 range. So there's not going to be any new builds, any significant supply coming on in terms of new builds until day rates move at least $200,000 a day higher. And, it just doesn't make any sense for somebody to make that investment. So that's kind of like what you're looking at is at least $675,000 a day rate. So it's about $200,000 a day higher than where the market is currently. And that's going to take a while for the market to reach that day rate. Getting to the second point of your question, I think this is the one thing that's different, because I used to cover oil field services and I covered onshore as well. And onshore, the investment cycle was much shorter. So you'd make an investment in like a land rig, or if you want to go out and drill a well in Texas, like your first oil is going to be coming, I don't know, 6 months later from when you actually make the decision. So in offshore, you make a decision like, hey, look, I'm going to go drill a well and build a project offshore Namibia. It's going to take 3 to 4 years to do that before you start getting first oil. So it just takes a long time. It's a slow moving industry. And sometimes people, I think, that would wrongly equate people that are familiar with oil field services. Onshore is just so much more different. It moves a lot faster. And I can tell sometimes some of these equity people, I'm a debt investor by nature, so I'm a lot more patient with some things. But in equity, like people want to see like prices move a lot faster. Offshore, it just moves slower. It's really difficult because you're building basically a lot of infrastructure 100 miles off the coast, whether that be in the Atlantic Ocean in most cases, and you got to build a bunch of infrastructure around it. It's not just getting a drill ship, but you've got a bunch of subsea equipment. You've got FPSOs you got to have built. It just takes a very long time to happen. So I tell people, okay, you just have to be patient with this cycle. And the one thing also too, getting back to a past question that you had, in terms of what's different today versus what was in 2015 and 16, the one thing that just really killed the market was OPEC. Saudi Arabia got really upset, as well as maybe some other members of OPEC, about United States growing production significantly. So they just flooded the market with oil. It was a price war. Oil went down to like $32 a barrel, if I remember correctly, in like January of 2016. That can really kill offshore production if Saudi Arabia were to do something like that again. What we see today is generally supportive of the market. They want to see oil prices, I think, anywhere between $70 and $100 a barrel, and they're going to try to, tinker with oil production in whatever ways that they can until we get there. But the market seems to be supportive of higher oil prices from OPEC. And that can change. There's geopolitical risk and all of this stuff, but that's a big thing to follow as it relates to risk in this asset class. Because if OPEC wants to kill the market, they potentially can. What I think is interesting, though, and what gives me some more confidence, and this was kind of an interesting thing on the last OPEC meeting a few weeks ago, was there was news about Brazil joining OPEC. And I think that they're just going to join as like an observer in the group. But Brazil, which is Petrobras, I mean, they're just basically like the Saudi Arabia of deep water oil production. And the fact that OPEC is allowing them into the club shows that they might be supportive of offshore oil production in terms of the thoughts. Like, if they wanted to kill the market, they could do it, but then they'd also be killing some of their own members as well, and that they're inviting into the club.
Yeah,
So
that is big news.
we'll
That
see.
yeah, we will, but it is potentially lining up exactly as you mentioned there, that everyone's got an interest in keeping that oil at least range bound, not below 70. So with these offshore cycles, how long does a typical cycle take before we start to look at individual names? But like a shale cycle, you can get things running super quickly, but you front end load all of your production, or 80% of your production, and a lot of that then becomes super gassy. It takes 3 or 4 years, you mentioned, to get some of these projects up and running. What's the life cycle of those particular projects? If oil tanks, do they have to um, shut these down, or because they're on long-term contracts, they just keep running as is?
Yeah, so if you're Total or Petrobras or Chevron, Shell, you make these investments, it's multi-billion dollars, and most of the cost is upfront. So the actual variable cost of running these things, once you've made all of the investment, building out the infrastructure, the subsea equipment, all the engineering, the cost to keep them running, it just doesn't make a lot of sense for them to shut oil production down. I don't think there's a ton of examples of that in the deep water industry that I'm aware of in terms of shutting in production, just because the variable costs are quite low. A lot of the cost is upfront. Yeah, it takes a long time. I will say that, in terms of, I get pretty excited because I look at a lot of exploration and companies making investments in projects. And I think people would look at that normally and think that, like, oh my God, there's a bunch of oil supply coming onto the market. And there is. It's largely coming from offshore, I think, over the next decade, really. It's not a ton of oil, honestly, when you look at it in the grand scheme of things. You're adding a few million barrels of oil. And, honestly, I think it's offsetting natural decline. This is part of the reason why I think the oil market is uh, so frustrating and so stressful to follow, because there's a natural decline rate every year of existing oil production
That was my
of,
next
you
question.
know, yeah, I mean, it's like 4 to 5% annual. It depends on who you ask, but generally across the world, it's about 4 to 5%. And you need to make new investment to offset that natural decline.
And so, what are
It's
the
kind of hard
decline
to.
rates? What are the decline rates on production for a typical offshore project, if there
That's
is
a
such
good question. Yeah, no, it varies. So normally in some projects, I think you will see higher decline rates on offshore oil. However, offshore Brazil, some of those projects like the pre-salt, those decline rates are really low. You might see low single digits on the decline rates, as some people have told me.
one? Wow.
But it can, yeah, I would say like maybe anywhere between low single digits, which is like the pre-salt in Brazil, versus other parts of the world, you might be looking more at 10%. Now, the shale production, the decline rates are much greater. They're just very, very productive when you drill out in North Dakota or Texas, the Permian Basin. They're very productive early on, but then the decline rate's a lot more significant. Um, yeah, it's honestly, it can be really difficult managing Oil, you need to see it, like the market just gets, unbalanced, and like the price can move a lot based off of that. But decline rates, it's difficult to model, honestly. But with offshore, I would say Brazil's probably an exception. I would expect higher decline rates than the global average, which is about 4 to 5% is on a natural decline.
Okay, that is interesting though when you compare it to some of the onshore players. A lot of the Canadian names are seen as having low onshore decline rates, but they're still in the low to mid teens at best. So I think it's fascinating that if you can get a big, massive, say pre-salt project to single digits, I think that's I think that's remarkable.
Yeah, it is remarkable. Brazil's incredible. It's You just look at, Petrobras is so important. You always have to pay attention to what they're doing, but as it relates to the growth that they have, the low decline, the low cost of production, it's just Petrobras is just blessed with amazing offshore assets.
Indeed,
And
they
I
are.
will say, I don't want to talk too much. People don't want to listen to me talk about oil sands, but I do. I actually really like the
I
oil
do.
sands as well, with the low decline rate, the cash flows. I love it. I'm not going to say that much more about it because I don't think people care what I had to say about it, but I do really like the oil sands as well. The problem is it's all trapped in Alberta, and I know that they are building some pipelines that are leaving, but um, I just don't see a lot of growth as it relates to oil sands production in the future, as much as I think they're great assets.
It's interesting. I think
That's part of the
I look at it as almost like two sides of the same issue, because you're looking out into what I think is going to happen in the oil market, and it's difficult to get the timing right. But if you've got good quality assets with low declines, you've almost got that out of the money call option that if oil prices really move, you've got some of these talky names in Canada, for instance. And then presumably, if the oil price does what I think it may do, then obviously you can have more investment into the likes of the names that we're talking about here in terms of deep water. Do you have much? Where do you see the investment split in terms of your investment dollars? Do you have any investment dollars in the heavy oil sands versus offshore?
Yeah, so I have back I own, not that people need to care that much about my PA, but Cenovus Energy in Canada, ticker symbol CVE. That's a very large, they have steam assisted gravity drainage assets like in Christina Lake. That's not the traditional like surface mining that you see like in Fort McMurray, Alberta. I love Cenovus. They have a refining business. It's just, as you had mentioned, when oil prices go higher, you really get really good torque. Um, and the cash flows are just great because unlike shale, where the decline rates are so great and you have to continue to invest CapEx, oil sands, you don't really need to do that as much. And you have a very large reserve base. I have larger positions in offshore and deep water just because I think that there's just more growth there. And I just think there's just more upside long term. One of the differences, and we're starting to see some of it with like Venezuela and Guyana, is geopolitical risk. In Alberta, Canada, geopolitical risk is super low. But if you're in offshore oil, a lot of these places where they're doing exploration and where they're producing, you are kind of exposing yourself to some geopolitical risk. I am okay with that because normally if you have geopolitical risk, that means a lower valuation on the cash flows that you're getting from these assets. I think I'm okay with that because I just see a lot of growth in the offshore sector over the next 5 to 10 years. And growth is something that supports higher valuation. So I think that kind of offsets, hopefully, the geopolitical risk, as long as we don't see war breaking out in Namibia or Brazil or Guyana, which I don't think we're going to see. But yeah, it's just a risk you have to monitor. Geopolitics and oil, you just have to deal with it. You have to pay attention, and it's just an unfortunate part of the market.
It's part of the game. You wake up and you find out that there's a coup in Gabon, and you're invested in you're invested in that. It's never fun. Anyway,
No, it's not fun.
let's move on to some of the names in which you are super involved in, the likes of the Transoceans, the Valarises, the Diamonds of the world, and then slightly outside of that, we've got our Tidewaters. Um, you mentioned that you were a fan of my thesis on Transocean, and back when it was just toxic and no one wanted it. Using your expertise as a credit analyst, how would you rate Transocean's balance sheet today? And do you think they're going to get to this promised land of supercharged cash flows into the future?
Great question and great work also too. I saw your video on YouTube. I was telling Benjamin before this, but great call on this. You were before I was actually on it, so great call. Back in, I don't know, 2021, 2022. Um, um, I'm very bullish on asset valuations of these offshore rigs. And part of the reason why I like Transocean is because, as I mentioned, like they didn't file for bankruptcy. So all of their debt remains. So if you're somebody that wants to have debt leverage to this concept, to the cash flows and to asset valuations of the rigs, Transocean is, as long as you're comfortable with the credit, where they're not going to have to restructure their balance sheet and go through bankruptcy, which I really, really believe that is not going to be the case with Transocean. I think that they are able to service their debt well, absent some idiosyncratic risk. I think that whether something crazy happens to an offshore rig and Transocean is liable for it and that could push them into bankruptcy, I think that's a really low probability. But I'm very comfortable with it. Transocean is a higher beta name because it has that financial leverage, all of the debt. When you look at Diamond, Valaris, Noble, all good companies, I like them. However, they all went through bankruptcies, so they don't have a lot of debt on their balance sheet. Now, that might appeal to some people, where they don't want to have the debt leverage and all of the volatility and the high beta to like an already very high beta industry. Their assets are fine. It's the same thesis applies. A lot of the time, I told you at the start of this that I look at the specs of these drilling rigs, and I can sit and talk to you for hours about the differences and why this drill ship versus the other one. I'm not going to bore everybody with that. But ultimately, it's all the same thesis largely. It's just how much more risk do you want to take? Transocean has the debt leverage on their balance sheet.
And what about the
Tidewater.
risk? What about the risk of dilution on Transocean before we move on? So if you're fairly comfortable with the debt levels, which are astronomical, but they really are the biggest player in terms of the deep water, right? So
Yes.
what's the chances that shareholders are going to get smacked with a dilution one or more times before they really start cash flowing this thing?
I don't think they need to do it. And if they needed to raise money, like let's say that they needed $400 million, $300 million, what I would do if I were Transocean CFO was they have unencumbered drill ships, which are assets that haven't been pledged to other pieces of debt. They have a few of these drill ships that if they really wanted to go to the market, they could pledge it as collateral and they could raise the money and get a successful bond issuance off, as long as there was a contract attached to the drill ship, which they have a few of them, which they could use if they wanted to. Transocean's already done this in 2023. They've done a handful of secured deals. The market absorbed them very well, so that's an option. I do not think that Transocean needs to do a dilutive equity issuance just to raise cash for liquidity purposes. I mentioned you can look at their fleet status report, you can model out their cash flows. I think they cover everything fine, including the amortization on their debt, the principal amortization. I feel comfortable with it. I will say though, with dilution, they do have convertible notes that are outstanding. So back when this was a toxic stock, when you were figuring this out, you made a great call on it. Congratulations. The cost of capital was a lot higher for them back then, and they had to do convertible note issuances. So if you go out and you look at shares outstanding today versus when these convertible notes will eventually convert, there will be more shares that will be issued. That's not new news. That's been out there for years when they did those issuances. So that dilution, I think, it's a part of, I guess, the bear case on Transocean. But as it relates to new issue equity that they'd have to do. I don't think they need to do it.
So we've covered the debt and the equity risk. How does Transocean compare then to the Valaris and the Tidewaters and the diamonds, I should say? So if we're so confident
Yeah.
in this thesis, should we take as should we lever up to the gills like a pair of degenerates, or what does the responsible man, what does the credit analyst say?
Well, you gotta be careful if you ask me on this. I like Transocean the most. Now it does have a higher valuation. I think some of the higher valuation that they have is they have a management team that's been in place. They do a really good job. I think very highly of their management team. They have a lot of scale as well. They have assets all across the globe, and they're different types of drill ships and semi-submersible rigs. So they're very well diversified, which can kind of help their cash flows during down periods if a certain type of drilling rig is oversupplied at any particular time. The one difference that I would say between Valaris and Transocean and Diamond and Noble is that Transocean, and they love talking about it, they have harsh environment semi-submersible rigs. These are different from drill ships. These are ones that are designed to work in Norway and harsh environment climates, which would include east coast of Canada. Namibia is an area. Also, too, in Australia, you can get some harsh environment clients, environments as well. Transocean has about 7 of these types of rigs that are eligible to work in Norway. And if you follow what Transocean has been saying, and it's not just them, it's Offshore as well as some others that are, Var Energy, some of these E&P companies as well. They really acknowledge is like, hey, look, this market, when I was talking about the big new build cycle of last cycle, they were building a ton of drill ships, a ton of them. The market's kind of still absorbing that supply on drill ships. However, they kind of stopped making these harsh environment semi-submersible rigs in the last cycle, largely because they were used to be used by Norway, which was kind of viewed more as a mature market. And the market is really short of these particular types of offshore drilling rigs, the ultra deep water, harsh environment, semi-submersible rigs. Transocean has them.
It's really only Transocean that's got them, yeah.
Ojfell, and I apologize to the Norwegians listening to this if I'm mispronouncing it. I love that company. It trades on the Oslo exchange, but they have some really good rigs as well. The Norway specific ones. Also, too, there's Seadrill has a couple of them. There's a company called Northern Ocean, which is they own 2 of them. It's just a really small subscale producer that bought these because Seadrill, during their bankruptcy, they never paid the shipyard. So they, Northern Ocean kind of opportunistically bought these things at a cheap price, and they own them now. So those are the companies that have that exposure. And I expect in 2024, day rates in those particular harsh environment semi-submersible rigs to outperform drill ships. I think that after 2024, you're going to start to see drill ships start to do a little bit better. The reason why I believe that is because there's still some stranded new build supply of these drill ships that were ordered 10 years ago. They're still looking to find work. And it's just that incremental supply that's sidelined that is suppressing day rates from appreciating as fast as other drilling rigs. I think that's going to clear in 2024. But we're going to have to watch the market, watch what the E&Ps, the IOCs are doing on their exploration and production work offshore that would use the drill ships.
Yeah, makes sense. It all makes.
Sorry if that was confusing, but yeah, I spent a lot of time
absolutely.
looking at this stuff.
And I think you nailed it in terms of it seems to be the harsh environment that's a key differentiating factor.
And let me just and just really quickly, before people get upset with me, Noble, Diamond, and Valaris, they all have semi-submersible rigs as well, and they're fine. They're not Norway eligible though. And I think that's the difference. You'd like to be, that just is another source of demand. And it's a large market that I think is actually going to start to grow modestly in the future. So Those other companies have semi-submersible rigs. They're just not Norway eligible. Norway has very high standards in terms of what they require of a semi-submersible rig to have to work in Norway. So that's just the difference.
Okay. Benefits of knowing those spec sheets that you mentioned.
Yeah.
Bef- Before we move on into the difference of the contracting cycles between like the OSVs and these types of drill ships, if you were to look at it today in terms of coming up with an asset valuation, how would the credit analyst do it for, say, Transocean? So would you value the cost of replacement to the fleet and then look at the debt stack and say, okay, well, here's my net asset value. What are we trading at a price to that net asset value? I'd be interested in see how your mind works with regards to that, because that's how I started. I said, okay, well, what's if I were to replace this business today, roughly, what's my estimate as a cost per share? I put it at the time was around sort of $14-15 in the event of a bankruptcy. And I think I started buying when it was just below $3. How do you approach it?
I think you did a great job, Benjamin. That's how I would have done it as well. It's more of an asset-based way of valuing the company. I will say when you're looking at replacement value of these rigs, you have to just be careful a little bit on that because you want to make sure that day rates are ever, for replacement value to be relevant, you need to have day rates get to a level where there's new build activity. And we're not there yet. I mentioned, on the higher spec 7G types of drill ships, like, day rates are 460 to 480K US dollar. It's still $200,000 below new build, which new build, at least that's the lowest level. I think that new build is probably going to require higher day rates than, upper 600s. But for that to happen and for replacement value to be more relevant, you need to see day rates get higher. I think that we do get there, but I spend a lot of time on E&Ps. The reason why you get there is that there's just going to be a lot of demand by companies like Equinor, Petrobras, Total, Chevron, Shell, where they're doing, and they need to get these offshore drilling rigs to do their offshore projects. And the thesis is that there's not going to be enough supply of these rigs to these deep water projects because there's no new build. So for replacement value to get there, you just really need to see day rates get to those levels. But that's
And getting the
exactly how I
timing
would do
right.
it. Yeah, the timing. Well, it's difficult to do. It's a volatile industry. I mean, this is super high beta. When the stock market goes lower, these offshore rig companies, as much as I love them, like, they trade lower. They trade with oil prices. It's hard to time that stuff. You just have to be patient long term and pay attention that these companies are continuing to invest. Demand is increasing to eat up the existing sideline supply of drill ships. And if that happens, then there's no new incremental supply, and it's just pure economics. These companies are going to bid up very few assets to the point where they need to build more of them, and that's when the replacement value really comes in. And honestly, when they start building some of these, they're going to be building the newer spec, higher spec types of drill ships and semi-submersibles, and those are probably going to be $1 billion or more. They're not going to build the lower spec stuff, I don't think. So there's a really high bar. It could take a while. This is long cycle. It takes a long time for this to play out, but
And so how are you
I agree
playing?
with your thought process.
How are you playing that? Are you just straight equity? Do you buy any of the debt, given that that's where your expertise lies? Are you looking at options? What's the main way that you like to play these? Just pure and simple equity?
Yeah, the first way I did it was I was buying the unsecured. I'm a debt person, so I just speak that language. So I first bought the unsecured bonds of Transocean. They were yielding really high levels, and I just felt that this was par credit, and it was eventually going to pay off at par.
So
Buy
talk
the
me
discount.
through that as an equity guy that doesn't understand much about this. What sort of yields were we talking, and what were they trading at in compared to par value when you bought them?
Yeah, so the particular bonds that I bought, I was buying them around 80 cents on the dollar. They had coupons of, I believe, 7.5%. So I think the yield to maturity on those was mid to upper teens at the time. Those have rallied. I kind of moved on from that just because I got even more bullish the cycle, and I started to move more towards equities. Just because the debt, there's only so much upside on it. It's like you're just going to get par back. And if you really believe in the thesis, you should buy the equity. As it relates to options, leaps are a good way to do it if you are very patient. If you're buying short-dated call options on some of these companies, you're just really exposing yourself to a lot of short-term risk that is really difficult to manage. It all depends upon individual circumstances, how much risk you're willing to take, how patient you're going to be. I prefer the equities just because there's a decay on the options over time, and you're kind of exposing yourself to that. And the risk with this cycle, and we're kind of seeing it, is that it can get delayed. Things might not move as fast as you're hoping. And when you're long options, that decay can kind of eat away at you, if it just takes longer for the cycle to play out. So
There's always something that just moves it back. It moves it back just enough outside your expiration date. It's super annoying.
Yeah, I know. Tell me, I know. I try to avoid that, but some people are higher risk tolerances than me. I'm a debt investor by trade, so I worked in banking. I'm just more conservative. So some people are a lot more have higher risk tolerances than me.
Makes sense. So let's talk about what I view this as the black sheep of the family, and I'm talking about Tidewater only because it's a service vessel supplier, right? So talk me through the differences between how it contracts versus the other guys. So I believe it has a shorter cycle, sort of 6 months, and then they roll over. So in the event of a bull market, that's awesome, right? You can get higher and higher contracts more frequently. How do you see Tidewater, and what would you allocate as a percentage towards the OSVs versus the drill ships that we've spent a lot of time on so far?
Yeah, great question again. You're right. It's short cycle on Tidewater, and I would say in terms of black sheep, I mean it's a really good company. They have really good assets. They have a lot of scale. Um, it is shorter cycle. Um, the day rates appreciate faster. Now, in a down cycle, they go down faster just because you have shorter contract times. But as it relates, if you don't like the patience that's required of having these offshore drilling rigs, then you might prefer Tidewater as it relates to it just being a shorter cycle thing. The thesis should not take as long to play out. It is good to have. I'm gonna refrain from making investment recommendations in terms of percentage allocations. I will say though that if you're Petrobras or Chevron, you have to contract not only Tidewater, these offshore supply vessels, but you've got these drilling rigs. And sometimes based upon supply and demand in particular regions, the OSVs might have more pricing power and they might get higher day rates in certain circumstances. So it's good to own both, I feel like, if you like the cycle, just because they're all fighting for the CapEx dollars of these international oil companies that are making these very large investments. And sometimes the drilling rig companies will win out, and sometimes the OSVs will. So I like the diversification side in terms of getting those. I will say the one difference, and this is kind of why I like the drilling rigs more, is not only just because I'm more patient, but it takes a lot longer to build a drill ship, and it's going to cost close to $1 billion. I think so. It takes a very long time to do that. It's a very large financial commitment that I think a lot of companies are going to try to avoid doing. On the OSVs, they're kind of just boats. There's not a whole lot of specifications or high spec equipment on them. Now they are very impressive, but you might be talking about $60 to $70 million to build one of those, and it doesn't take quite as long to do that. So there is potentially new build that would come in a little bit faster on OSVs theoretically than what you would see on the offshore drilling rigs.
Yeah, that's a good point. There's just the barriers to entry are a lot different. I mean, with $1 billion for this big drill ship versus the OSVs, I think that's a significant factor. Then again, on the other hand, you mentioned the left tail risk. If something goes wrong and the likes of a Transocean is liable, you can't insure these things, right? So at least the OSVs wouldn't have that risk associated with them, would they? How do you see it?
Yeah, probably not. They're at less of a risk. I will say that in most cases, if there is some sort of, I'm not an expert on this, but this is kind of like the way it played out in Deepwater Horizon, was the E&Ps and the IOCs are the ones that have the deep pockets and have the ability to make those payments. And I think ultimately, they always say like who the operator is. It's ExxonMobil who's largely responsible for this stuff. Um, I will say though, I'm not an expert on the legalities on this stuff. I do think that the OSVs will have less risk than the drilling rig operators, but ultimately, if there's, heaven forbid, some sort of oil spill or something like that, I would guess in most cases it would be the IOC or E&P that's mostly held responsible. Obviously, after Deepwater Horizon, there's been a ton of improvements as it relates to the equipment and redundancy on these offshore rigs to avoid situations like that. So um, I think the risk of that is pretty low. But knock on wood, we'll see how things play out.
Okay, yeah, I mean, I guess it makes sense if Transocean essentially are leasing their equipment, but yeah, I don't know either where the duty of care lies on that side of the contract. So, my friend, we're coming up on the hour. Is there anything I've missed that you would like to comment on?
Really fast, and I don't want to bore. I don't want to run too much longer. But all the capex offshore that's being done, there's a lot of exploration that's being done right now. So when you're following where the market is going, it's going to come from demand from potential exploration success offshore. So these areas, places of the globe to follow over the next couple years, Namibia is a massive area for exploration right now. There's a ton of companies that want exposure there. It's very, very large. First oil is probably, I don't know, 3, 4, at the earliest, 3 to 4 years away, but they are hiring drilling rigs to go out there and do exploration activities. The north coast of Brazil, like Equatorial Margin, there's Petrobras is out drilling there. There's actually been some good licensing activity as well in southern Brazil, in Uruguay as well. And, companies are buying blocks to do exploration. And, just because they hire a rig to go out there and start drilling doesn't mean that they're going to have positive results. There will always be negative results on offshore drilling exploration. But that's going to be a key thing to follow as it relates to successful finds, because successful finds ultimately turn into more demand for offshore rigs. And that's how we get to higher day rates, like your replacement value in terms of your analysis. So that's what I spend a lot of my time following. And it's going to be really relevant to the future of the offshore industry is the success and capex investment of these E&Ps and international and national oil companies.
Makes perfect sense. A question on day rates before we wrap up. Contracts, where are we at in terms of contracts due to be renewed? Do we have a whole heap that are about to roll over? I'm just thinking in comparison to the uranium market, where you've got these term contracts, and they also, a lot of them seem to be lining up at the same time where they'll need to be renewed. Where are we at in terms of the contracting cycle for the likes of the Transoceans and the Valarises that have got those sort of longer yearly contracts?
That's a great question. I'm I'm not. I will say I think that it's a fairly even roll off. I would say over time. All these companies have contracts rolling off in 2024, 2025. There's no particular year that stands out to me as like, oh my God, there's a whole bunch of incremental supply coming on that's just going to like overwhelm the market at one particular time. Um, so there's nothing that stands out. That's a really good question, Benjamin, but there's no particular year that stands out to me as just being a bunch of incremental supply that's going to weigh down the market. I think the thing mainly to follow on that question in terms of supply that could weigh down the market It's just the incremental supply. It's those drilling rigs, the stranded new builds that were ordered in 2013 that still don't have an owner and still don't have work. I expect a lot of those rigs to find work in 2024. Petrobras is adding a few rigs. There's a few companies as well that are off coast or Western Africa, where there's going to be additional demand, also Namibia as well. So that's the thing I think to follow more so than an individual year is a great question by you. But I think the sideline capacity on drill ships is going to be the thing to follow in 2024. And
Yeah, I should I
I'm
should have thought of it
cautiously
earlier, but I
optimistic.
just thought of it. I just wondered if there
No,
was.
it's a great question. No, it's a great question. I'm cautiously optimistic. If you listen to all these companies in their conference calls, and all these companies are naturally bullish because they want people to buy their stock and people to feel positive. But there seems to be a decent enough demand for those stranded new builds to find work in 2024. And then also too, I mentioned at the beginning of this, cold stacked rigs. There's about 5 or 6 7G cold stacked rigs that are just sitting there waiting for contracts. So I think that over the next 12 months, most of those are going to find work, and then there's just not a whole lot of incremental supply, and that's when day rates should hopefully appreciate if oil prices cooperate.
Yeah, I'll be definitely keeping an eye on that, and we'll have to catch up and chat about that as it unfolds. So you see just more of a steady grind upwards in the day rates as each individual vessel or drill ship rolls over, and the contracts presumably need to be negotiated higher. Last question around cold stack. It costs a lot of money to get these things out of cold stack. And so how do we know that these things don't need a lot more maintenance capex spent on them before they're ready to go out onto the ocean?
Yeah, another great question. Some of these companies have done a better job maintaining their drill ships in cold stacked rigs than others. Typically, what people guide, this number keeps on growing over the last year. Right now they're guiding towards reactivation costs on some of these cold stacks of anywhere between $75 to $150 million. Transocean has very publicly communicated, like if you want to contract one of these, you're going to have to pay the reactivation costs, which is a big check to cut by whomever, Total or Shell or Chevron, whoever wants to take one of these. I'm not so optimistic that the operator, the E&P, is going to be one that pays all of that. I think that ultimately the drilling rig operators are going to have to pay some of it. But when you compare the incremental cost to reactivate these, which is anywhere between $75 to $150 million, I wouldn't be surprised if a few of these need more than that, like $200 million reactivation. You look at that versus the
What I'm
new build
thinking.
cost to build a new one, where you're getting $800 to $1 billion. It's a really small investment to make compared to, a new build. So I think it's a cost that can be met. And yeah, that's the key topic to follow as well.
Absolutely fascinating. Well, thank you so much. This has been a super interesting conversation. Thank you for joining me in your first podcast. I'm sure you're going to get a lot more invitations now on the back of this. Before I wrap it up, is there anything you'd like to leave us with?
No, I just, honestly, Benjamin, I really appreciate you inviting me on. And honestly, this Twitter account thing that I've done, it's been a lot of fun. It's been a fun hobby for me. And I really appreciate all the positive engagement that people have had, even as times that have been really difficult over the last couple of months, as relates to oil prices and equity prices. But it's just a part of the game. It's patience. And I really appreciate the opportunity to speak with you, Benjamin.
My pleasure, sir. So, at Tommy Deepwater is his handle. Link will be in the description, guys. Take care. Have a wonderful rest of your week, wherever you may be listening from around the world, and make sure you do your own due diligence. I'll be back with another episode of the ROI podcast shortly. Take care.